what you get? Nothing. So in this session, I'm just going to share with you what are the other possible avenues where we can park our surplus cash, and then there are plus points and minus point and all other things. So that is the objective of this session. Okay, so basically how to improve the efficiency and effective utilization of our funds. So when I said, like, I'm going to buy a Mercedes-Benz S-Class, and by deploying the money in some fixed instruments and then making money from the stock market, so that's a very active. So people say, sir, you know how to take the risk, you know how to handle the risk, but we do not want to take the risk. So in this session, so in the first part of the session, and I'm going to discuss only non-risky things. Of course, we can't say use the word non-risky. Even the bank FD is subject to risk. You know what happened to few banks? Few banks have gone bankrupt. So do you know that if your bank goes bankrupt, your fixed deposit or your money will be insured for only 1 lakh rupees? I think recently one Mumbai-based cooperative bank has gone bankrupt. So people had a lot of problem. And then the government decided to increase this insurance from 1 lakh to 5 lakh. So theoretically speaking, even a bank can go bankrupt. It has happened in the past. What happened to Lakshmi Vilas Bank recently? So luckily, these banks were taken over by some other banks. So investors' return interest was protected. So maybe more appropriate will be, I can use the word less riskier, not the stock market, not the futures and options where PR Sundar is very famous. So we are not going to talk about it. So effectively, if you want to use the funds, so as I told you, FD has two drawbacks. One is lower interest rates, and second one is the liquidity. So I don't have to tell so much about financial world. So anything that we do, we invest, and three things are very, very important. We call it as SLR. SLR. S stands for safety. So the number one is we have to look for safety. And second one is the liquidity. L stands for liquidity. And the third one is return. So return is the last priority. The first priority is safety. Second priority is liquidity. The third priority is return. So if you come to safety, fixed deposit, okay, it's more or less safe. But liquidity, there's a problem. Once you commit, let us say 1 year FD, you have to keep it for 1 year. So liquidity is an issue. So you want to pre-close, there may be some penal charges. And the third one is the return. Yeah, return is also a little bit lower. But apart from the fixed deposit, so there are so many options available in the market. So I'm just going to give you some. So debt funds. Generally, the funds are classified into two. One is the equity funds, one is the debt funds. Equity funds are the funds that are being deployed in the equity market, which will carry the market risk. Whereas the debt funds are more or less like a fixed deposit, and where the risk is much lower. Like how much risk you will have a FD, the same kind of risk may have. So we can say no risk. So there are so many funds called overnight funds where the returns are about 4% per annum. So bank FD and this one is quite similar, but then why we have to park here? Number one, you park the money in FD, the interest that you are getting, so that is considered to be a income in your books, and you will end up paying about 25% tax. Any income that you are getting, if you're a corporate, like it's from 22% to 25%. Whereas if you park the funds in these overnight funds, they are treated as mutual funds. So they are treated as investment. So who knows, if you don't require the funds for the next 1 year, and after 1 year it becomes a long-term capital gain. If it's a below one year, it's treated as a short-term capital gain tax. So short-term capital gain tax is only 15% versus 25% taxation for fixed deposit. So number one, you get your tax outflow will be less. And second thing, FD, if you pre-close, there'll be penal charges, but here no such charges. So anytime you can invest and anytime you can take it back. So maybe you can just go to Google and just search overnight funds. So there are so many overnight funds available in the market, which are giving better return than the FD return. Then there are funds called liquid funds. And there is something called liquid Bs. So that liquid Bs, I'm going to show you, it is traded in the stock market. So this is a liquid Bs. It's called Nippon India Exchange Traded Fund Liquid Bs. And you'll see this will be always trading around 1,000 rupees only. So 1,000 rupees plus or minus 1 paisa, 2 paisa most of the time. So you want to park your funds, you can park here also. And the advantage is that when you are buying or selling, there will be no government taxes. In stock market, when we trade, when we buy or sell, we pay STT, security transaction tax, stamp duty, and many other charges. But the government of India has given exemption for this particular instrument called liquid Bs. You don't pay any charges. Most of the brokers, they don't even charge the brokerage. No brokerage, no taxes, nothing. You buy for 1,000 rupees. Anytime you want to sell, you also sell for 1,000 rupees. There will be no loss, there will be no gain. But then you may ask one question, sir, when there is no gain, so why we have to block it? And the interest will be around 3 to 4% for this instrument. So this interest will also be added into the units. Say, for example, you buy 1,000 unit. After 1 month, your interest is, let us say, 10 unit, 10,000 rupees. So instead of paying you the interest of 10,000 rupees, they will add 10 units into your account. So last month, if you buy 1,000 units, this month you look at it, you will have about 1,010 units. So the interest will be given to you in the form of units. So in fact, as far as I know, this is the only instrument where the exemptions are given by the government of India to buy and sell in stock market. So this has to be bought and sold through stock exchange. No STT, no stamp duty, no SEBI charges, nothing. And many top brokers, they don't even charge the brokerage. Then there are some other funds called ultra short-term funds. So ultra short-term funds, by nature, they are very, very short-term in nature. So you can put money there also. So by looking at all these things, the funds which I've given, whether it is of overnight funds or liquid funds or ultra short-term funds, your return is not going to be significantly higher than the FD return. It will be more or less the same. But only advantage here is that it can be liquidated at any time. And second one is a taxation. So the tax outflow will be less. Forget about the companies. Talk about the individual people. Some ultra HNI clients. Some ultra HNI clients, if they have some extra money, if they put it in FD, if their total income is more than 5 crore, the taxation will work out to be 42%. So if they put money in FD, the interest that they're getting, they have to pay 42% tax. But if they put it in these funds, so they'll end up paying only 10 to 15% as the tax. So straight away they say 30 to 35% tax. 30 to 35% savings in tax for HNI clients is a very big savings. But corporate taxation is less. The company's tax, I think if your profit is less than 1 crore, it is 22%. If it's more than 1 crore, along with the surcharge, it will be only around 25%. So these are the few things available. Now, suppose you have some surplus cash and you don't need that money in the foreseeable future. Maybe you have some lot of funds, you're looking to invest in some real estate or some big expenses, but you have to keep on looking at it, so you don't know when it will materialize. Until then, why to keep the money in bank? So who knows, it may take even 1 year, 2 years also. So for slightly longer term, so what are the alternates? So my favorite one, most of my money, I invest an instrument called Bharat bond. So maybe I can just show you. You go to this website called Bharat bond. You just go to Google, type Bharat bond, you'll get the Bharat bond exchange traded fund. So it's called bharatbond.in. So this is a very, very famous instrument. In the beginning, as I told you, I'm a trader and I'm a stock market trader. I trade only in options. When I trade in options, I don't have to pay the money to the exchange in cash. I have to give collateral. So majority of my money is put into this. And this is given as a collateral to the exchange. And what is this Bharat bond? This is an exchange traded fund. You can buy and sell from the stock market. And there are 4 bonds, one maturing in 23, one maturing in 25, one maturing in 2030, one maturing in 2031. Suppose today you go and invest in Bharat bond. So what is the interest rates that you are likely to get? So in 23 bond is 4.71%, 25 bond is 5.53%, 2030 bond is 6.78, and 2031 6.79. In fact, this 2030 bond which came about 1.5 years before, and they've given 7.5% interest. So that time I invested a lot of money. So now the interest rate has come down. This is not the interest rate, this is the yield. So I'm sure you know what is the difference between interest rate and yield. So interest rate is the interest that the exchange traded fund will be paying you. But when you buy that bonds in the market, the bond may be trading at a premium or the bond may be trading at a discount. So depending upon whether it's trading in a premium or discount, so the yield will change. So right now, these bonds are trading at a good premium. So that's why the yield has come down. So first, what is the advantage? The number one advantage, so we are getting an interest rate which is around 7%. I don't think that any bank will give you this kind of FD return. So FD returns are much less compared to this one. So the first interesting thing is return is much higher compared to other instruments. Number two, just now I told you there are three things: SLR, safety, liquidity, and return. So look at the safety, and the money collected from this exchange traded fund is only given as a loan to public sector companies like Power Finance Corporation, Rural Electrification Limited, ONGC, Bharat Heavy Electricals. So there are so many public sector companies. So the money collected from here is lent to public sector companies. So which is backed by the government. So safety wise, though we cannot say 100%, even some countries in the world, they've defaulted. So theoretically speaking, even government of India can default. So you can say 99.9999%. So this is safe.